A very good afternoon to everyone here, and thank you so much for joining in. Welcome to Transfin's first virtual seminar on investing essentials. Hi, Sharath. How's it going, man?
It's going very well. I'm very excited about today's chat, and I also like the format that we have taken. And I genuinely hope that of our multiple listeners, a few of them can take home or take with them a basic understanding of some framework around investing.
Absolutely. And speaking of format, this is a live stream session, so we will be having a Q&A by the end of it. So would welcome all our listeners to drop in your questions or comments through the chat option on YouTube, and we'll try to go through as many questions as we can once the session ends. This is first of multiple virtual seminars that we plan to hold. Obviously, this is the first session, so I would like to call it a session for beginners.
Yeah.
But as we go, I am hoping that we'll go deeper and deeper into the entire world of investing and financial planning. So it's very excited to kick this off, and we already have 2 cups of coffee in and 2 cups in front of us.
Yeah.
And so this is, I think, a good time to start things over. But before we do that, I think I would like to throw what this session is not about. We are not going to make any investing recommendations. We will try to refrain from discussing the logistics or admin of investing, in the sense that, how to kind of choose a broker, or how to create a demat account. I think there's plenty of information available online.
Yeah,
with
even
regard to the same.
we have put out some information.
Yeah, so we have a series of articles. Team has done some excellent work on that. So I'm happy to, I think, post the links in the description. But would really appreciate if the listeners would focus on the framework and the concept of investing rather than the logistics and operationalization of it at this stage.
Yeah.
In terms of this particular seminar, I think we are going to look at broadly 4 things, right? We are going to look at which category of investor you belong to. It needs to be determined before you even start things over.
Yeah.
Not all investors are the same. Some have more time, some have more knowledge, some have more bandwidth, some have more interest, and some don't. And that, I think, is a very critical first question that needs to be addressed. Then we are going to follow it up by going through which particular product classes are relevant for you once you have determined what kind of investor you are. Then we'll kind of determine why they might be relevant for you, and lastly, how to potentially get started. So the interesting thing is that right now we have around 1.3 billion people in our country, and only 50 million people have demat accounts. Only 75 million people have mutual funds. So I guess it's a very, very, very low penetration, right? It's like less than 5%. So I think with the advent of demonetization, GST, and rising formalization, it's only natural that more and more people are getting interested in financial products.
Yeah, and listen, we're not complaining, because what it means is the runway is huge.
Yeah.
So there's a lot of room here for people to learn and dabble. And like Nikhil said, I mean, our objective here is to help people build some kind of intuition around their own personal investing style. That's sort of the idea here, and we already laid it out. It's not specific advice on what to buy or what to trade. It's more to build a framework which should help you over the long term. And investing is something that doesn't happen it's not a one-day affair or a 2-day affair. It's more of a lifestyle approach, right?
Absolutely. So with that, I think we can go straight to page number 2. This is the broad agenda that we are going to cover through these virtual seminars, and this is going to be a repeated slide, I think, so it's good to just go through it quickly. So the broad agenda that we want to cover through 4 to 5 sessions in the future are pretty much in front of you. We are going to only cover the first 3 points today. So we are going to discuss why should you invest, how is it different from saving. A lot of people confuse between investing and saving. They think that they are synonymous activities, while they are not. And there are different stages in life when you save, and there are different stages in life when you invest, and they both have different objectives.
Yeah, so which we'll talk about in detail.
We'll try to lay that out. And second is kind of categorizing yourself kind of as what kind of an investor you are, and because that is closely correlated to your risk return profile, your risk appetite. So that's a very, very critical question. A lot of people miss it.
Yeah, and investing, a lot of investing is about having a discipline. So this sort of ties in with that. And investor, what type of investor am I can move and evolve over time. But at every point of time, I think one must understand and know what kind of investor they are at that given point of time.
Absolutely, and since it's not at all fun only talking about things from a theoretical perspective, the third big area that we'll cover today is how to correlate the entire activity of investing and where you stand with which products and services you should expose yourself to.
Yeah.
So that's point number 3 here. Where do you sit? Basically, where do you sit? How are you going to think about the product? As you say, the product individual fit. And just to kind of make it clear how this entire session or agenda will work. Obviously, red is the stuff we'll cover today, as I just highlighted. Blue is the stuff we'll cover in the future sessions, and green is the stuff that we have already covered, which at this point of time is nothing.
Yeah.
So
all that we've spoken thus far accounts for 0.
Yes. So I think I'll just graze through this page again, but quickly, these are hopefully the takeaways that you'll pick from this session. Identify if you need to start investing, what type of investor you are, and what type of products are relevant for you. So let's jump into it. So Sharath, we often hear investing, saving. What's the difference? What do you think? Where do you think we should draw the line?
Yeah, I mean, listen, there are different ways of thinking about it. For me, investment generally ties in with a specific asset, which in turn helps you grow income. That's one way of looking at it, I guess.
So investing equals to putting money into some kind of an asset. Now, asset is something which basically generates an income.
Yeah.
It can be tangible, it can be intangible, but like if I kind of put money in the bank and it's in a savings account, I'll make some return on that as well, right? So would that be called investing?
No, I don't think so. I mean, that's time frames are, I guess, another factor, but it's the bank account itself is not helping you grow your income.
Correct.
So for me, it's more of savings inclined, but on the other hand, if it's some kind of asset, like we can talk about multiple assets, but let's take something like an equity or a stock,
right.
Then for me that helps you generate income, so that's more investing.
So a bank account is not really an asset.
No.
Right?
No.
I mean, a bank account, because I think, and the reason is that even though a bank account probably, or a savings account probably gives you a 4.5-5% rate of interest, effectively that's equal to the rate of inflation.
Yeah.
So in real terms, you don't really make much.
Nothing. Yeah.
Right. So so let's say investing is putting money into some kind of an asset which generates a real return.
Correct. Yeah.
So
with the hope of at least generating. Yeah.
Absolutely. So a lot of things can kind of fit in that, right? You have mutual funds, you have bonds, you have stock markets. You have options, you have precious metals, commodities, and you also have things like deposits, fixed deposits, which are slightly more return yielding versus plain savings accounts. And you have Sharath's favorite asset class, art.
Yeah.
So
it's my favorite. I've never gone down that road, but maybe one day.
Yeah. You have a room just for that, right? At your place.
Yeah. But so Nikhil, like if I have a bunch of money which is taped behind my toilet,
yes,
that's not really investing, is it?
That's not investing. Yeah, I mean, I think
that's worse than parking it in a bank.
I think the activity that is happening in the toilet is probably more productive than doing that. Yeah. Anyways, so the difference between investing and saving is obviously we need a real return. We need a real significant return on investing. Secondly, investing and saving are broadly about the same thing, but they happen over different time spans and they have different objectives, right? Now, the way to kind of probably look at objectives and time horizons is to look at the typical life cycle of any would-be investor, right? So anyone on the face of the planet, I think, his or her life can be split into two broad parts, right? One is when they are working, when they're actively engaged in the workforce, and the second part is when they retire. The first part in financial planning lingo is called the accumulation phase, right? That's when net you actually make money. And the second part is the decumulation phase, when you need to have some sort of a surplus in your bank, and your income is no longer the way it used to be earlier, and your healthcare expenses go up, and you need basically retirement planning solutions. That's the decumulation phase.
Correct. Yeah, and the idea is to sort of try to, when cash inflows into your bank account sort of diminishes or go down, at that time you're trying to look for an alternative source of cash flow generation, right?
Correct.
And you have to plant the seeds for that early.
Correct.
And that sort of is the accumulation phase, correct?
Correct. So I guess investing is pretty essential for the decumulation phase.
Yeah.
Right? That's what it is at the end of the day, right? And saving is something that complements the accumulation phase. Is
Sort
that a
of,
good way
yes.
of putting it?
I think so, yeah.
Yeah. So I mean, that kind of, I think, kind of is a good, neat way of determining the difference between the two activities. So on the right hand side, there's a interesting, like, by the way, these charts are not these basically we have Googled for these terms, and whatever charts and tables we found which were relevant to this conversation, we have included them in the deck. We didn't even have the courtesy to actually cite them as sources, but it's a live session, so that's fine. But the idea being that, typically when a first time investor will typically Google things.
Yeah.
And when they Google things, they see a lot of stuff. So we thought that it's a nice way of just using these visuals to set the framework and pick what is relevant and discard what is not.
Yeah.
So on the right hand side, there's a very interesting chart which shows the age group, age profile on the x-axis, and I would say wealth creation on the y-axis. And you can see that in savings matter early in life. When you are young, when you are starting to make some money, which you start parking somewhere, which earns some amount of, I would say, nominal or even real return.
Yeah.
And it's just prudence.
Yeah.
Right. Whereas investment is something that kind of helps you in the longer term, and it really dominates your lifestyle later.
It's a more targeted approach, right?
It's more calculated. It accumulates over time. It doesn't start from day one. You need to technically have some sort of a buffer, cash, to even dabble in that activity. And whereas savings is much more process driven. It's like, I make 50,000, I pay 25,000 of rent, I use 10,000 for my monthly groceries and living costs, whatever is remaining goes in the bank.
Yeah.
Right. So that's I think is the difference between the two. They are fundamentally very different activities. And I think the next slide kind of gives a good idea of it in terms of the time horizon and the objectives. So as you can see, saving has a much shorter time horizon, and investing is a longer time horizon and has much more ambitious objectives linked to it, right?
Yeah, listen, savings, like we said, right, the real benefit of investing sort of starts kicking in when your cash inflows sort of recede, right?
Yeah.
So that's why, it's fairly intuitive that the benefits you're looking for, or the approach, or the process is greater than equal to 5 years. I mean, 5 years is the lower end. It can go on till like 20, 30, 40 years, right? Savings, on the other hand, are sort of just, like you said, like just putting some money from your, whatever it is, like, your source of income, your primary source of income, and just putting some of it aside, which you want to dabble for maybe some, like, holiday shopping or vacation or traveling. It's a different thing, Nikhil, though. These days people are doing that on credit as well.
Yeah.
But let's not go there.
Yeah, so that's a third category here, that you can just borrow money and do it. But that's the millennial, I think, trend that we're seeing in the market. But in the traditional sense, I think it's very essential whether you're saving money or you're investing money, and why you're doing that.
Yeah.
So if you have to plan for your kids' college education, or if you have to plan for retirement, or if you want to actually buy a house with your own equity 30 years down the line, then investing is the answer for you. But if you want to basically buy a TV by the end of the year, or go to Thailand on a holiday, maybe saving is the way to go about it.
Yeah.
So it's different horizons, different objectives, and interestingly, obviously, a different set of products. which match for each of them. We'll go into these products later. I'm sure you all have heard a lot about these names. FDs.
I don't know. I don't think there's a single Indian person who hasn't heard the word FD and
FD,
fixed deposit
yes, so
in our age profile at least.
So FDs are a saving tool. They are not an investing tool. And mutual funds, especially on the equity end, are more investing tools. And stocks obviously sit on the investing pools. And real estate. Oh, we missed art, man. We missed art. Art should have also been there, or right that side.
Yeah.
So yeah, that's kind of a broad demarcation. So yeah, this is just to kind of give you a sense of where the difference lies. Now, more interestingly, we have to see where you sit, right? So from that perspective, you need to ask yourself a few questions before you even start dabbling into the activity of investing. A few things that you need to wonder about probably are whether you are an active investor, whether you're a passive investor, what's your age, are you about to retire, and what your fundamental goals are. Now, again, we Googled all of these things. We use the most solid piece of resource we all have.
Yeah.
And we again found there are millions of ways of figuring this out. For instance,
the pizza pie charts. I love those.
The pizza pie charts have come in from Motilal Oswal. It's a broker.
Yeah.
So they think that there are two types of investors: ones who invest in mutual funds and the others who put money everywhere else.
Mm-hmm.
Then they also say that there are investors who don't redeem, who just redeploy, and there are investors who actually put in money, take an exit, put in money, take an exit. I think it makes a good graphics.
Yeah.
It doesn't really answer the question where you sit. We found some other stuff also. Then we found stuff like this, where they say that you might be a passive, low risk preserver investor. Again, Sharath, can you make any sense out of that?
No, I mean, I do understand that any investing conversation cannot take place without the use of the word risk.
Yes.
But it still is all over the place. I don't know how to interpret this. It's not fair. It's not very intuitive.
I'm an active high risk accumulator.
Yeah.
I'm just realizing that. So there are many ways of defining this. There are many ways of determining what type of investor you are.
Yeah.
But we think this particular framework now, which you see on your screens, is pretty handy. Let's look at three things. Let's look at whether you have interest, whether you have time, and whether you have knowledge.
And interest, by interest we mean interest to do things, not the financial term interest.
No.
Yeah.
Interest in the markets,
Passion,
interest in the products, you give a care about this. So if when you look at these three variables, interest, time, and knowledge, if the answer to that is no, any one of that is no, that you don't either have the time, you don't have the knowledge, or you don't have the interest or inclination to do this, then you're a passive investor. Okay, it's pretty.
Yeah, it's very intuitive. Yeah.
Yeah, and if it's a yes for all three of them, not one, I guess all three of them, then you're an active investor.
Yeah.
Right, and so if a good way to kind of think about it is if I look at my father. I mean, he's a civil servant. He has least interest in investing, right? But he does think it's important.
Yeah.
But he doesn't have the time or the inclination to do it. He's a passive investor.
Yeah, and I think most of our listeners and most of us, most of the people that you'd meet on a daily basis are passive investors.
Yeah.
It's a very specialized skill set to be an active investor. It's those three check boxes: interest, time, knowledge, together to be checked off is not an easy thing to accomplish, right?
Absolutely. And on below the active investor, we've also mentioned something called the day trader, which is basically like an alpha active investor, right? I mean, that's probably another degree altogether.
Yeah, extremely specialized, right? I mean, you're closing positions on a daily basis. We'll talk about that later, but it's basically very, very specialized.
Right. So I think the question is whether these three things check for you. If they do, then you're an active investor. If they don't, then you're a passive investor. And this is important to know because this determines what type of products you should be exposed to.
Yeah.
Right. And the other thing that actually is important here is your age profile. Where you sit, because one is your inclination or your interest or your time. The other is actually having the financial bandwidth or the time frame with you to actually conduct this activity. So again, I'll kind of rehash to the chart that we showed earlier. So if you're young, by young I mean you're doing your first job, you've just started making some money.
Yeah.
There's a good chance that you won't have a lot of buffer to start investing.
Yeah.
So then save money.
Yeah.
When you start. But as soon as you start kind of rising up the ranks, once you maybe cross 30, right, and when your paychecks become more and more generous, that's probably the time when you start investing.
Seriously investing, yeah. I mean, there are cases, I mean, there are people at a young age who want to dabble with the idea and get their hands dirty. Sure, I mean, that's also fairly acceptable and fairly popular as well.
Yeah.
But like you said, like once you start seeing a meaningful, when your savings are there and the next layer of, the next slice of, money that you can take out and start deploying, that's when you really start formally investing, right?
Yeah, yeah. And when one is a retiree, that's the time for financial comfort, right? So I think the idea of looking at this is that when you're young or younger or mature, your risk appetite is generally high.
Yeah.
Your cash surplus is generally high. That's the ideal time to start investing. And once you are like 55, 60, that's the time to actually reap the benefits of that. So one shouldn't start planning for retirement when you retire.
Yeah.
That should happen 20 years or 30 years before you're about to retire. So both these lenses have to be put in to identify where you sit, your interest, time, and knowledge, and which part of the age demographic and professional demographic one sits in.
Yeah, and like the benefits of investing cannot be seen on day number 2 or day number 5, right?
Yeah.
It's a long process. You see it much later, so it makes sense. Yeah.
Right. And I think that pretty much sums up how to pigeonhole oneself in a particular investing category. But the more interesting thing is how that maps against various product classes, right? Now, I think we can do this exercise in a bottom-up manner, right? So the most basic parameter here is the risk-return framework.
The most popular usage of phrase in corporate finance.
Absolutely. Corporate finance, personal finance, finance at large. So, the basic fundamental rule here is that if you are taking a higher risk, you should be compensated by a higher return.
Yeah.
And it kind of works both ways.
Yeah.
Right? So, I think one has to see where one sits across the risk-return spectrum.
Yeah.
To start with.
And that's probably the fundamental thing, right? Understanding your risk appetite,
right.
Understanding your risk profile,
right.
And like it is said, right? High risk, high return, low risk, low return. It's that everything revolves around it.
And from, I think, both the product spectrum as well as the investment horizon / appetite spectrum can be mapped across this high risk return paradigm, right?
Yeah, I agree.
And I think if we can kind of start going into the different types of products, but before we go into the actual product classes, it's good to know what is the broad way of looking at financial products to start with, right?
Sure, yeah.
And there are two: debt and equity.
Yeah.
And some other stuff.
Yeah, I mean, everything. Debt equity pretty much covers most of it, right? I mean, the two most popular ways of looking at asset classes or instruments as such, and even from a personal finance, but also from a corporate finance. I mean, these are the two big buckets that you can pretty much classify most things in.
Right.
Obviously, there are other, like structures, and that's why you have debt-like and equity-like, but I think this is a solid way to think about it.
Right. And if you like... from a differentiation perspective, equity is where you become a part owner of the asset you invest in. Equity is where you take more risk, you expect a higher return, your returns are not capped. So it's like, equity is like buying a stock, right? Buying a share of a company.
Yeah.
And say tomorrow the share price goes up, you get the benefit. If it goes down, you take the loss. Nothing is guaranteed.
Yeah.
You are taking market risk here. And because you're a part owner, and you're being compensated by a higher risk. Debt is it's a debt. So it's basically where, it's like you are giving a loan to a company. So it's like you're buying a corporate bond, type of instrument where your returns are capped, but they are, I think, more or less guaranteed.
Yeah, I mean, you know exactly your stream of cash inflows, you know the timing of those cash flows, and you know the amount of it. So it's fairly sits low on the risk profile. On, like you said, on the equity, like the upside is unlimited. A stock price can go from 0 to infinity technically. So, but because it can do that, it can also bottom out at 0.
Right.
And sort of you're taking a higher risk, but the upside is unlimited.
Right. And another way of looking at, I think, debt and equity is from the perspective of yield and capital gain.
Yeah.
Right. So we'll obviously go into these concepts in more detail in future sessions. But equity, the benefit of capital gain is much more than the benefit of capital gain in case of debt.
Yeah.
That's another way of looking at it.
Yeah.
So where does the typical investor sit with regard to these product categories? So a saver or a passive investor, a saver being someone who has a shorter time horizon and who has a non-ambitious objective, and a passive investor being someone who doesn't have the time or the interest or the knowledge to actually conduct investing, they should pretty much focus on more debt-like instruments, right? And they obviously have a bit of they have a bit of optionality on the equity side as well, but they are kind of sitting on the lower risk, lower return spectrum. And the active investor sits on the high risk, high return spectrum. Is that a good way of putting it?
Yeah, I think so. Like you said, right? I mean, you can't think of investment without thinking of risk. And as you move towards the right-hand side, your risk profile increases and you require time, knowledge, and interest. And that sort of ties in with the active investor framework, right?
And I think for our listeners, it will be good. It will be good exercise to first answer where you sit. Whether you're a saver, whether you're a passive investor, whether you're an active investor, and then take it from there.
Yeah.
And then let's look at specific products, right? I'll just put all of them in front on the screen. So these, I think, products are pretty well known, and that's how they actually sit across the risk return, debt, equity, saver, active investor spectrum.
Yeah.
So obviously we all know of savings accounts, the most popular, well-known thing. Basically, your typical savings account, that's a saver's account. Then you have a fixed deposit. That's also pretty well known. I think a good way of differentiating between them is what's the entry and exit obligation, and what is the yield versus capital return. Right?
Yeah.
So I think we can go start from the left, go towards the right, one by one. What do you say?
Yeah, sure, makes sense. Yeah.
Savings account, I think we all know. You basically put some buffer in your savings account. You get like a 4.5-5% interest on it.
Yeah, it's probably the easiest action as well. It's literally just putting money in a bank, and
it's potentially risk-free unless you are in like Punjab National Bank or something.
Yeah.
It's a potentially risk-free way of going about things. But obviously it's very low return, so it doesn't do much beyond the limit. FD, fixed deposit, is, as Sharath pointed out, probably the most heard of option. That's pretty much like a savings account, but there is an exit obligation.
It's a lock-in period
Yeah, your money gets locked in for a good period of time, maybe 5 years, maybe 7 years, and you get obviously a slightly higher return. You might get like a 7.5-8% on it. Again, it's pretty risk-free.
Yeah.
Right. But again, you're taking exposure against your bank. So if your bank itself is in doldrums, then it can be very risky as well.
Which is we speak about this so freely.
Yeah.
I mean, which is such a big thing anyway.
Yeah.
But we've had some cases, I guess.
Yeah. So as soon as you start making your salary, make sure that you have something or the other coming in your savings account. Make sure that you start putting in some money in FDs. That kind of goes without saying, right? Then you kind of go towards the entire MF, which are mutual funds. Basically, there are 3 categories of it, right? That we have put here from left to right: short-term debt mutual funds, long-term debt mutual funds, and equity mutual funds. So, Sharath, if I have to describe mutual funds, how would you go about it?
Yeah, I know. Mutual fund is for me is just a portfolio of multiple stocks. Let's call it 20, 30, whatever, which is managed by a professional.
Right.
And chances are that professional is active investor, but it's managed by a professional investor. It's a diversified portfolio, and you as an investor are buying a piece of that portfolio and getting exposure to the skill set of the manager, the portfolio manager. And it's a fair assumption to make that the portfolio manager has time, has knowledge, and has interest. So essentially, you as a passive investor are getting exposure to an active guy who understands it. And that's sort of taking a diversified approach to the instruments. Now, obviously, there's debt and there's equity, which is fairly straightforward or intuitive. Like a debt mutual fund will hold 30 or 20 or whatever different debt instruments. On the flip side, an equity mutual fund will hold all equity. Now, there are hybrids as well, but typically that's how I would think about it.
Yeah. And I think the idea here is that the portfolio manager will charge some sort of a trailing commission
Correct,
to
yeah.
manage your money,
Yeah.
and that's where they are incentivized.
Yeah.
Or they're not incentivized maybe sometimes because they're just charging a commission.
Yeah.
But the idea being that you are passive, so you don't want to do it yourself, you give it to an expert to do it on your behalf.
Yeah.
And I think coupling 30 stocks or 30 debt instruments basically also gives that benefit of diversification.
Which is key, yeah.
Which is key here for a passive investor especially.
Yeah.
So by diversification, I think the idea is that out of 30, if say 15 stocks go down, there should be some stocks which actually go up,
Yeah.
which kind of gives you a hedge.
Yeah.
And diversification obviously kind of puts some sort of a I would say charge on your returns.
Sure, yeah.
I think they bring it down,
Yeah.
but they make it slightly more stable.
Yeah.
So that's a kind of cost benefit that one needs to do.
Yeah.
And but we've also put something known as index funds here, which is I think quite similar to mutual funds, but index funds are where the basket of stocks are correlated one-on-one to existing index like a Nifty 50 or a Sensex or a Nifty Auto. And the idea there is that there's like that efficient market hypothesis, right? That there's no one who can actually beat the returns,
Yeah.
considering information is flowing efficiently. So index funds just kind of monetizes that by saying that don't give your money to a professional manager, just put your money in a fund which is kind of linked to an actual index, and you'll be fine.
Yeah, it's basically diversification on steroids, if you will. You're
Yeah.
just diversifying your, increasing your diversification from 20 to 30 to 40 to 50, essentially, until you cover every stock that trades.
Yeah.
So you essentially mimic the index,
Yeah.
and there is no further diversification benefit possible within that ecosystem.
Yeah.
So yeah, I mean, obviously, like you said, it probably eats into your returns, but it's probably a very diversified approach, and you're essentially betting on the economy or the market or the
Yeah.
sector or the index, right?
Yeah. And I think the good thing is it's cheaper. It's
Yeah.
much cheaper than actually dabbling in
Because you
mutual
don't
funds.
need a portfolio manager anymore.
Yeah, so there's no trade, there's no problem of any fee or commissions or charges on top. Right?
Who's the person who was credited with sort of I think it was what was
John Bogle, right?
Yeah,
Vanguard.
Yeah, I think
Vanguard.
they're the ones who sort of came up, or he's the one who came up with the idea of index funds, and yeah.
And there's also another interesting thing which are called ETFs, exchange traded funds. So they are like any mutual fund or any index fund, but the fund itself can be traded. So it's like the fund behaves like an individual stock. So that's again a layered product. It's getting fairly popular. Globally, it's very, very popular. I think US now almost 55% of AUM of US financial products is locked in ETFs now.
Yeah.
In India, I think it's fairly new.
Yeah.
But it's pretty handy. So it kind of gives you the idea, or it adds a layer of liquidity on top of the diversification.
Yeah.
So I think we have kind of these are very viable options for a passive investor. And then if you go into the active category, it's things like stocks and bonds, right? It's individual companies.
Yeah, individual
And,
pieces. Yeah.
They're obviously not. They are concentrated in terms of risk. They potentially can be very high return. Potentially can be can destroy all the money you have put in.
Yeah.
That's where it's important to be an active investor. It's important to actually analyze, track the companies in which you put in your money.
Yeah.
To see how their earnings are going up and down, because it's singular companies, right?
Yeah.
So there's no diversification benefit that you get from there.
Yeah, and you need skills and discipline to understand when to cut your losses,
Yeah.
understand when to when to be exposed to a particular stock or a company, when not to. So these are all specialized skill sets which take years or a lot of knowledge and time to build.
Absolutely. So I think that's a good way to probably close today's session. Maybe we can just go through a quick jargon buster. We used a lot of I think we threw a lot of jargon today.
Yeah. That wasn't intentional, folks.
Yeah, but it was just something that one has to to kind of just even navigate through these concepts. So let's go through a few words that we kind of threw. So yeah, asset is anything that makes you a real income, I would say, right? Then investing and saving, I think, is pretty clear. They are pretty synonymous activities, but they differ widely in terms of time frame and objectives.
Yeah.
Accumulation is the stage in life from maybe 18 years of age to 60, 65 till you retire, when net you actually make money. Decumulation is when you have retired and you need money. So accumulation is the time when you start investing, and decumulation when you reap the benefits of investing.
And decumulation is sort of reaping the benefits of all the hard work that you've done during the accumulation phase.
Yes, having a
Back end loaded, as they say.
Pina colada on the beach phase. Then you need to ask yourself whether you're an active investor, i.e., do you have time, do you have interest, do you have the knowledge to invest, or you are a passive investor where you lack any of these three things or one of these three things. You need to know what your entry obligation is when you put your money in the sense that if you put in your money, does anybody charge you anything to put in your money?
Yeah.
Exit obligations, when you put in your money, after how long can you take it out, at what terms do you take it out?
Yeah.
Right, so that creates a lot of differentiation between the products that we classified
Yeah,
earlier.
and mathematically it affects the return number.
Return number, absolutely. Then we talked about debt. So debt and equity are broad ways of looking at any financial product, right? Debt is where your returns are capped, they are guaranteed, and it's low risk. Equity is where your returns are not capped, but they're not guaranteed, so it's high risk. Yield, capital gain. I think best way to look at it is best way to look at capital gain is probably you buy something at 100, you sell it at 200.
Yeah, and your capital gain on that is 100, pre-tax obviously.
And how would you look at yield? In terms of if you, for instance, you put 100 in the bank and you get 5% on it.
So five
is the yield.
5% is the yield.
Right.
But, a lot of people trade stocks based on yields as well.
Right.
Dividend yield or free cash yield.
So for an equity, if you buy a stock, you get a dividend out, that's a yield.
That's a yield.
But if you buy a stock and you sell it at a higher number,
that's a
capital gain.
Yeah.
Right. Similarly, if you buy a bond or a debt instrument, you get some coupon or interest on it, that's the yield. If the bond prices tomorrow changes, you sell it, you make a gain, that's a capital gain.
Yeah.
I think real estate is a good way of also looking at it, right? Real estate is probably, you buy a building and you sell it, it's a capital gain. You buy a building and you put it on rent, you get a yield.
Yeah.
So that's, I think, a good way of putting that around. So yeah, with that, I think today's session probably we can close. These were the three topics that we thought we'll start with, and now they are covered. In the next session, we'll be talking about risk return, debt equity, yield versus capital gain, and concentrated versus diversification in a much more detail. And looking forward to that. And with that, I think pretty much we are done.
Yeah, I had a great chat, and let's see if we can take some of those questions.
Absolutely. So yeah, we are all up for the Q&A.